Hello. Today we will discuss an option strategy known as the long combo. The purpose of this discussion is to provide a clear and detailed explanation of how this trade works. We will break down its components, its risks, and its potential rewards. This strategy is an advanced one and requires a solid understanding of options before you attempt to use it. It is not designed for everyone. For those with the right market outlook and risk tolerance, it can be a powerful tool for portfolio growth. We will proceed methodically, ensuring each concept is easy to follow. This is a capital gain strategy. You are not using this strategy to generate a regular stream of income. Instead, the long combo is a directional bet. Enter at one price and exit at a much higher price, capturing a substantial capital gain. A long combo, also known as a synthetic long stock position, is constructed using two different options contracts. The two legs, one long call and one short put, are on the same underlying and typically share the same expiration date. You buy a call option and simultaneously sell a put option. Both contracts refer to the same stock and usually the same expiration. Together, they create a single unified strategy that mimics owning the stock. The call gives you the right to buy the stock. The sold put creates an obligation to buy the stock at its strike if exercised. This often reduces initial cash outlay. The put premium helps finance the call and can even create a small net credit. The call provides unlimited upside as the stock rises, but that financing comes with significant risk from the naked put obligation. Remember, this is a capital gain strategy, not an income plan. Your primary goal is a large one-time profit driven by a stock price rise, not collecting small recurring payments. In a bullish move, the long call gains and the short put can expire worthless, letting you keep the premium. The long combo is an explicitly bullish strategy. Deploy it only when your analysis leads to a firm conclusion that a stock is poised for a significant upward move. The entire profit engine is geared to capturing upside momentum. If you are uncertain or expect sideways or downward movement, this is not the appropriate strategy. As price climbs above the call strike, the option's value can increase without practical limit. In a bullish scenario, the short put typically expires worthless, reducing your effective cost basis. If the stock falls, the long call loses value, and the short put becomes a significant liability. This is a directional bet on price, not a bet on volatility or time decay. Ask not only if it will go up, but how confident you are and how significant the move could be. There is no protection against a downward move, making strong bullish conviction essential before committing capital. The concept of uncapped risk and reward is central. First, uncapped reward. The long call offers, in theory, unlimited profit potential. For every dollar above the call strike, the option's intrinsic value increases by $1. A truly explosive rally can deliver extraordinary returns on a modest capital outlay. By paying a small net debit, or sometimes receiving a net credit, you access the same upside as a stockholder. Now the other edge, uncapped risk, originates from the short put. If exercised, you are obligated to buy the stock at the strike, regardless of how far it has fallen. Your loss is the strike minus the market price, less the small premium received, potentially enormous. This is the trade-off for reduced entry cost and uncapped reward. Uncapped downside. It's considered advanced, not for beginners or low risk tolerance. Be prepared, mentally and financially, for a worst-case scenario. Losses are not contained, they can grow as long as price falls, making risk management absolutely critical. To make this concrete, let's walk through a hypothetical example using Meta platforms, ticker Meta. Assume today is 3 November 2025, and Meta trades at $300 per share. Your analysis suggests it's undervalued and could rally towards $380 over the next few months. You select an expiration roughly 3 months out and choose out-of-the-money strikes. You buy one $320 call for $15 per share. With 100 shares per contract, that costs $1,500. Simultaneously, you sell one $280 put for $10 per share, receiving $1,000. Net debit, $500. That $500 is not your maximum loss. Your broker will require margin for the short put. At expiration, if Meta is $380, your $320 call is $60 in the money. That call is worth $6,000. The $280 short put expires worthless. Your profit equals $6,000 minus your $500 initial cost, $5,500 net. This is a capital gain strategy designed for a bullish environment with uncapped risk and reward. The first step is the most important. Confirm your bullish thesis and your risk tolerance. This is not for casual speculation. It's a calculated risk demanding clear assessment of rewards and consequences. Select your stock and an expiration far enough for your scenario to unfold. Shorter dated options are cheaper but decay faster. Longer dated cost more but give more time. Typically, buy an out-of-the-money call and sell an out-of-the-money put. Closer strikes increase cost but need a smaller move. Farther strikes reduce cost but need a bigger move. Enter as a single combo order so both legs fill simultaneously at a net price. Avoid placing separate orders to reduce legging risk and unintended positions. After fill, verify both the long call and short put are correctly listed in your positions. Effective trade management requires a well-defined exit plan. Set a clear profit target, based on the stock price, like Meta at $380, or on the combo value, such as 100% or 200% return. Close by reversing. Sell to close your long call and buy to close your short put, ideally as one combo order. The closing net credit minus your initial cost is your final profit. Given uncapped risk on the short put, set predetermined exits, e.g., break key support, or a 50% loss on the combo. Manage expiration. If the put is in the money, you risk assignment. Buy back the short put before expiry to avoid unwanted shares. Alternatively, roll, close current options and open later dated ones to give the trade more time. When you sell a naked put, brokers require margin, real capital set aside as collateral that fluctuates with market conditions. It's driven by stock price, strike price, volatility, and time to expiration. If risk rises, margin can increase. A margin call forces you to deposit cash or liquidate positions, often at a bad time. American-style puts can be exercised anytime. If your short put is in the money, you can be assigned suddenly. Assignment obligates you to buy 100 shares at the strike, tying up capital. Risk peaks before ex-dividend dates. To remove assignment risk, buy back the short put. It locks in a loss on that leg but avoids unwanted stock. In summary, the long combo is powerful but advanced. It's built by buying a call and selling a put on the same stock with the same expiration. It synthetically mimics long stock, pursues large capital gains, and is used only with a bullish outlook. Expect uncapped reward and uncapped risk. Manage margin and assignment proactively. Have profit targets and strict stop-loss rules. As with our Meta example, potential gains can be large. But so can losses. Start very small or practice in a simulator before risking capital. Well, that's it. Good luck with your trades. Be careful. Thanks for watching and see you next time.